Wall Street just flashed a massive red alert, and this time, it's about the UK's biggest retail giants. We're talking about a major sell warning from top analysts, and when they sound the alarm, it's time to pay attention. This isn't just stock market noise, it's a signal about the real financial health of everyday people. When shoppers pull back at these major stores, it reveals deeper issues: rising costs, squeezed budgets, and economic uncertainty. The shockwaves could hit everything from jobs to the housing market. Today, I'll break down why Wall Street is so pessimistic, reveal the 3 household names at the center of this warning, and what it means for your money. Let's dive in. First up, Marks & Spencer, an icon of the British High Street. For generations, M&S has been woven into the fabric of British life, a place where families shop for school uniforms, Christmas treats, and everything in between. Its name conjures nostalgia, reliability, and a certain sense of national pride. But in today's rapidly changing retail landscape, even the most beloved institutions aren't immune to disruption. Once the go-to for everything from snacks to suits, M&S is now struggling to keep up with modern shoppers. The brand that once set trends is now chasing them, as consumer tastes evolve faster than ever. The days when M&S could rely on loyal, repeat customers are fading, replaced by a new generation that values speed, convenience, and digital experiences. Wall Street's sell rating is about more than just numbers. It's about a brand losing relevance. Investors are watching as M&S's market share erodes, and they're asking tough questions about whether the company can reinvent itself in time. The numbers tell a story of missed opportunities and a business model that's struggling to adapt. M&S's core shoppers are aging, while younger consumers flock to fast fashion and discount supermarkets. The brand's traditional strengths, quality, heritage, and service, don't resonate as strongly with Gen Z and millennials, who are more likely to browse Instagram than a department store aisle. This generational shift is leaving M&S caught between 2 worlds. Their massive, costly stores are becoming liabilities as shopping shifts online. Once a symbol of retail dominance, these sprawling locations now feel outdated and underused. The fixed costs of maintaining such large spaces are eating into profits, especially as foot traffic dwindles and more customers opt for the convenience of home delivery. Despite millions spent on digital upgrades and new clothing lines, analysts say it's too little, too late. M&S has launched new apps, refreshed its fashion ranges, and invested in online shopping, but these efforts haven't been enough to reverse years of decline. The competition is simply moving faster, and M&S's digital transformation is struggling to keep pace. The pandemic and cost of living crisis have accelerated changes in how and where people shop. Lockdowns forced millions to try online grocery shopping for the first time, and many haven't looked back. At the same time, rising prices have made shoppers more price-sensitive, pushing them toward budget retailers and away from traditional department stores. M&S is caught in the middle, squeezed by online-only brands and budget grocers. It's too expensive to compete with discounters, but not trendy enough to win over the fast fashion crowd. This leaves the company in a precarious position, fighting for relevance in a market that's moving on without it. Falling sales in high-margin areas, relentless discounting, and a slow turnaround plan have investors worried. The pressure to cut prices erodes profits, while the slow pace of change frustrates shareholders. Every quarter brings new challenges, and the path to recovery looks steeper with each passing year. The sell warning isn't just about M&S, it's a red flag for UK consumer confidence. When a household name like M&S struggles, it signals deeper problems in the economy. Consumers are tightening their belts, and retailers across the country are feeling the pinch. If even this iconic brand can't get people to spend, it signals real trouble for discretionary spending. Families are making tough choices, prioritizing essentials over extras, and the ripple effects are being felt throughout the retail sector. Wall Street sees too many risks, too much competition, and not enough progress. The verdict from investors is clear. Unless M&S can accelerate its transformation, it risks being left behind by more agile rivals. The verdict: M&S's transformation isn't happening fast enough, and the future looks tough. The company faces a long road ahead, with no guarantees of success. For now, the story of M&S is a cautionary tale about the dangers of standing still in a world that never stops changing. Next, let's look at the grocery sector, where even essentials are under threat, and the challenges facing M&S are just the beginning of a much bigger story in British retail. Now Tesco, the UK's largest supermarket and a household name for generations, finds itself at the center of a storm. For decades, Tesco has been the go-to destination for families up and down the country, a place where the weekly shop was almost a ritual. But today, the landscape is shifting beneath its feet. Once a symbol of stability and convenience for millions, Tesco now faces challenges that threaten its very foundation. The aisles are still busy, but the mood has changed. Shoppers are more cautious, more price-sensitive, and more willing to look elsewhere for a better deal. If Tesco is under pressure, it's a sign of deeper economic problems. The supermarket giant is often seen as a bellwether for the health of the British economy. When its profits falter, it's not just a company issue, it's a warning signal for the entire retail sector and beyond. The issue isn't that people stop buying food, it's how and where they're buying it. The traditional loyalty to one supermarket is fading. Shoppers are armed with apps, price comparison tools, and a willingness to split their shop to save every possible pound. Discount chains like Aldi and Lidl are winning over shoppers with lower prices, forcing Tesco into a costly price war. These discounters have mastered the art of efficiency, offering no-frills shopping and focusing relentlessly on value. Every price match or discount Tesco offers cuts into already thin profit margins. The club card deals and price promises are designed to keep customers loyal, but they come at a steep cost to the bottom line. Rising costs, energy, wages, goods, are squeezing profits. And Tesco can't pass it all on to customers without losing them. The cost of running massive stores, paying staff, and keeping shelves stocked has never been higher. Even loyal shoppers are trading down, switching to cheaper brands, buying less, and rethinking what's truly essential. The weekly shop is now a careful balancing act, with families scrutinizing every item and every price tag. Many are splitting their shop between stores, chasing deals and discounts wherever they can find them. It's a patchwork approach that reflects just how tough things have become for ordinary households. Wall Street sees this as a long-term trend, not a blip. Analysts believe the shift toward discount retailers and multi-store shopping is here to stay, reshaping the entire industry. Tesco's vast operations mean higher costs than leaner rivals, making it harder to compete on price. While discounters run smaller, more efficient stores, Tesco's scale, once its greatest strength, now feels like a heavy burden. Profit warnings from Tesco are a red flag for the whole sector. If the market leader is struggling, everyone is. Empty shelves and cautious forecasts are a stark reminder that no retailer is immune to the pressures of inflation and changing consumer habits. The sell rating is a bet that things will get worse before they get better. With discounters continuing to gain ground, investors are bracing for more turbulence as the battle for the basics intensifies. For investors, Tesco's future looks like low growth and shrinking margins. The days of easy expansion and reliable profits are over, replaced by a constant fight to hold on to market share. The fact that even essential retailers are under pressure says a lot about the state of UK households. When families are forced to make tough choices about food, it's a sign that the cost of living crisis is biting deep. If selling bread and milk is a struggle, the economic pain is real. Essentials have become a battleground, and the outcome will shape the future of British retail and the lives of millions. Now let's see what's happening at the premium end of the market, where a very different story is unfolding. Finally, we arrive at the John Lewis Partnership, an iconic British institution, home to the beloved John Lewis department stores and Waitrose supermarkets. For generations, these brands have stood as symbols of quality, trust, and a certain aspirational lifestyle, catering to the needs and desires of the UK's middle and upper middle class. Their stores have long been a destination for those seeking not just products, but an experience, one that promised attentive service, premium goods, and a sense of belonging to a more comfortable, stable Britain. This reputation wasn't built overnight. John Lewis and Waitrose earned their loyal following by consistently delivering on quality and service, making them household names among families who valued reliability and a touch of luxury. For decades, shopping here was a marker of having made it, a quiet badge of middle-class success. But today, even these shoppers, once thought to be insulated from economic storms, are feeling the squeeze. The cost of living crisis has crept up the social ladder, and the pressures that once only affected the most vulnerable are now being felt in the aisles of Waitrose and the showrooms of John Lewis. The company's core customers, who used to fill their trolleys with premium groceries and invest in high-end furniture, are now hesitating. Big-ticket purchases are being postponed or abandoned altogether, and even the weekly shop is being scrutinized for savings. The sense of security that once defined this demographic is eroding. The impact on John Lewis Partnership has been dramatic. The company has posted major losses, scrapped its famous employee bonus, a tradition that once set it apart as a model of shared prosperity, and dropped its iconic price match promise, never knowingly undersold. These are not just financial decisions, they are signals that the old certainties are gone. Department stores in particular are feeling the pain. As the housing market slows and consumer confidence falters, demand for furniture and home goods has plummeted. Once busy showrooms now echo with emptiness, and unsold stockpiles up on the shop floor. Meanwhile, Waitrose is facing a battle on a different front. Shoppers who once wouldn't have considered trading down are now flocking to discount supermarkets, lured by lower prices and aggressive promotions. To compete, Waitrose has been forced into a cycle of discounts and special offers, moves that eat into profits and threaten to dilute its carefully cultivated premium image. The financial world has taken notice. Wall Street's sell warning on John Lewis reflects a dual crisis: collapsing discretionary spending as consumers cut back on non-essentials, and a widespread flight to value, with shoppers prioritizing price over brand loyalty. This is a warning sign not just for John Lewis but for the entire sector. The partnership's unique structure, owned by its employees with a focus on consensus and long-term thinking, has historically been a strength. But in times of crisis, it can make the company slower to adapt. Expensive city center stores, once prized assets, are now burdensome as foot traffic dwindles and operating costs soar. When even Waitrose shoppers are putting luxury items back on the shelf and switching to supermarket-owned brands, it's a clear sign that the middle class is under real financial pressure. The old assumptions about who is safe from economic hardship no longer hold. This shift is more than just a retail story, it's a barometer for the whole economy. If the affluent are cutting back, it signals trouble ahead for growth, investment, and the broader sense of national prosperity. Rising debt, falling profits, and a risky turnaround plan have made John Lewis a tough sell for investors. The company faces mounting pressure to reinvent itself, but the path forward is uncertain and fraught with risk. The challenges are piling up: relentless online competition, the decline of traditional department stores, and brutal grocery price wars. Each of these would be difficult on its own. Together, they threaten the very foundation of the John Lewis Partnership. The sell rating from analysts is more than just a financial verdict. It's a stark warning that the current strategy isn't enough to fix deep, structural problems. Without bold action, the future of this British institution hangs in the balance. Together, these three stories paint a worrying picture of the UK consumer. The struggles of John Lewis and Waitrose are not isolated. They are a reflection of a broader crisis facing the middle class. As spending power erodes and confidence wanes, the ripple effects will be felt across the entire economy, raising urgent questions about what comes next for Britain's shoppers, retailers, and society as a whole. So, what does all this mean for you? Wall Street's sell warnings on M&S, Tesco, and John Lewis are more than stock tips. They're signals of a wider economic squeeze. Discretionary spending is down, essentials are under pressure, and even the affluent are cutting back. Now's the time to tighten your budget, build your emergency fund, and be cautious with investments exposed to UK retail. Watch retail sales, inflation, and consumer confidence data closely. These will show if the warnings turn into a recession. What do you think? Are you cutting back at these stores? Let me know in the comments. Thanks for watching. Don't forget to like and subscribe for more updates on how these shifts affect your wallet.